So Ronnie, this chart you just popped up, the great moderation to the great recklessness. What's going on here? What should we be absorbing from it?
What you can see here is starting in 1961 up till now, US CPI, then recessionary times, and also the decade average for the CPI. And as we can see, of course, the 60s, but then especially the 70s, where two decades of high inflation. And then Mr. Paul Volcker stepped in, and his job was to kill inflation, to
Mm-hmm.
stop inflation. And this basically triggered the Great Moderation. So for decades, where inflation constantly went lower and lower, 40 years. And now, of course, in 2008, 2009, we saw the great financial crisis. Then briefly, CPI spiked up. And then, of course, basically from 2012 until 2020, inflation numbers came in lower again. But from my point of view, the big difference between now and 2008, 2009 is, first of all, M2 is growing at a rapid rate. Back then, it was only base money that was up significantly. So I think now M2, which is much higher correlated to CPI, going through the roof and at even higher rates than in the 1970s. That's quite telling.
Well, also, you're covering a huge time frame here, going back 60 years. And in that time frame, they've changed the definition of CPI.
Yeah.
So, back in 81, they were, if you go by shadow stats, which still tracks inflation based on the 1981 standard, 1980 standard, inflation's already spiking up to those levels, right? 12, 14%.
Absolutely.
So it's a question of definitions also.
Yes, absolutely, totally agree. And I think it's important to say that the natural state of our economy and capitalism is deflationary. But within this monetary system, in this debt-based monetary system, deflation cannot be accepted. And I think if you have a look at money supply charts, at debt charts, we know that we are now kind of in this exponential phase where the threat of deflation, the higher the debt level, the greater the sensitivity to rising rates and the greater the sensitivity to deflation. So the desire for inflation is getting bigger and bigger, and now it is happening. Now, that doesn't necessarily mean that we will go into hyperinflation right away, but I think that people should at least become accustomed to an environment where 3, 4, 5% inflation rates will be the new normal. And I think this has started, and let's face it, I mean that's the only way out of the debt situation. I mean, growing out is basically impossible. I think a debt cut would be highly deflationary. If I was a politician, I would not take that risk. So of course, higher inflation, negative real rates, financial repression, that's the way forward. And I mean, I told you about those tremendous yields on government debt over here in the Eurozone. If you have, if you can finance yourself that cheaply in combination with negative real rates, with high inflation, I mean that solves the problem over a couple of years. Of course, somebody has to pay for that, and we all know that no sane investor would ever buy Greek debt with such yields. So of course, money is being directed and funneled into directions where it would normally never go to. So an institutional fund, for example, cannot buy any physical gold due to legal reasons. Yeah, it's too risky. Of course, he can buy 10-year Greek debt at negative rates. That's no problem at all. So this is the financial repression that is already happening.
They really actually prevent institutions from buying gold. Even though, are you saying like what sort of institutions are banned from buying gold? Banks or
No, for banks, I mean, I think they couldn't care less about gold, and I think this is something that in the gold community is always a bit overrated, that banks just stare at the price of gold all the time, and every time it goes up too much, they try to dump it. I mean, I worked in a bank for many years, and you know, the trading desk for gold is probably the least important one. Nobody really cares about gold yet.
yet?
But when it comes to pension funds, insurances, all the large institutional players, they I mean, it's legally it's possible, but it's very, very hard for them to buy physical gold. There was one pension fund from the Netherlands that actually bought physical gold. They substituted it for government bonds, and I think the regulator gave them a hard time. So this is happening, and this is, you know, this financial repression. As I've said, money is being directed in directions where it would normally never go to. Yeah.
So when you say that banks and institutions aren't allowed to buy gold, and we have Basel III, which makes gold a tier one asset, you know, I just find that surprising that the regulators would give a pension fund or someone an issue. Are they allowed to buy ETFs instead of physical, or is there some distinction there?
Well, the thing is, first of all, with this net stable funding ratio, we wrote about it in the last In Gold We Trust report, and I'm still, to be honest, it's very, very technical. But from my point of view, within the gold community, it is there's lots of wrong information, I think, in the gold community, and it's, as I've said, it's very technical. We talk to guys doing asset liability management, doing treasury, sitting in the banks, and of course, the new rules will mainly impact banks and their unallocated gold, as the majority of regular investors tend to hold physical allocated gold. The new liquidity requirements basically imply that banks will need to set aside more funding for an unallocated gold. But I think there's some confusion with the terminology, because Basel III does not recognize gold as a high quality liquid asset, and therefore requires 85% stable funding ratio, which reduces the incentive for banks to hold physical gold.
You're as gold market analyst, and you also look at the mining stocks. Do you have any sort of gut instinct on what's going on there that you want to share with the audience?
Well, you know, it's been a tough year for gold, and it's been even tougher for mining investors. And you know, the thing that I see, as you can see on this chart, for example, the gold mining companies, you know, they are producing record amounts of free cash flow. So they're making great money at this price level, and I really love this comparison. It's by Trey Rake, and he shows that the GDM index, for example, relative to the S&P 500, is dirt cheap on valuation metrics that we usually don't even use for mining stocks, because miners used to have very high PE ratios, pretty high price cash flow. But I think, as you can see here, the profitability of the mining space. Have a look at gross margin, operating margin, return on capital, free cash flow yield, dividend yield, 2.3%. I mean, for the mining space, this is ridiculous. So, from my point of view, it is I don't see mining stocks really making great performance without the price of gold stabilizing and going up again. But if you say that, well, I'm bullish on gold, then you should have a very close look at the mining space, because I'm doing this for 15 years now, and I've lost lots of hair managing mining equities and analyzing them. So actually, I'm only 30 years old, but I look like 60 sometimes. So it's a pretty tough industry.
But yet, you look at these numbers, and this is with 1,800 gold,
Yeah.
$1,800 gold. These gross margins and profit margins and the dividend yields.
Yeah.
These companies have been paying down debt. I mean, most of them are net debt zero.
Yeah.
If gold were to go to 2,000, 2,500, these numbers start looking stupid. I mean, they already look crazy, but these numbers would just be insane at 20. If the gold mining stocks didn't move with it, it's unfathomable.
And the thing is, now we've got the tax loss season, tax loss selling season. This is ending pretty quickly. We did some work on the seasonality of gold, and actually, the week before Christmas, seasonality is becoming better, and the tax loss season is ending, obviously. I think that most of the mining companies, and we saw that with all the M&A activity, with Great Bear being taken over, with the acquisition of Pretium by Newcrest. I think there's quite a lot going on below the surface. And as you've rightly said, most of the big companies, they're actually planning with gold prices, long-term gold prices at 13 or 1400. So they don't need gold to explode significantly higher. But of course, if it's going to happen, and it will happen, then they're making huge amounts of cash flow. And I'm also sure that they will make, or many of them will make, the same mistakes like in the previous cycle. So there will be
overpaying for projects, you mean?
Absolutely. They will take on ridiculous political risk. So it's going to happen, but then that's of course the job of the fund manager to identify which companies will avoid those mistakes.
Well, on that note, Ronnie, we really want to thank you for joining us and sharing your knowledge with our audience.
Yeah.
And we look forward to talking with you again in a few months as the market develops in 2022.
Absolutely. Merry Christmas, Happy New Year. Be good, and I hope that we'll see each other again at the Beaver Creek Conference. That was fun having a beer with you.
Definitely.
All right.